I understand why Bitcoin went from 19,000 on March 13th after the weekend of Signature and Silicon Valley Bank basically going into receivership. It was a flight to safety, 19,000 to nearly 28,000. That proof of concept right there, decentralized, transparent, auditable, and so forth. Many people had their money in deposits at the bank. And this crisis actually has forced them to focus on what they're earning in the banks versus what they could get into money markets. So you see them in their minds, what they're saying is, I am going to lower my risk by leaving the banking system and increase my return. Now, isn't that upside down? That's not how the world works. And this I worry about from a bank deposit point of view. And the reason for this is lending. And ultimately, lending is going to shut down.
Today, we have the CEO of ARK Invest, Cathie Wood, discussing the risks associated with the current economic crisis and the role Bitcoin will play. Wood expresses concern about people withdrawing their money from bank deposits and shares how it will impact lending activities. She notes that many people are losing faith in the safety of banks and moving their money to digital assets like Bitcoin in search of safety. Wood also shares her view on how the Fed will react to this trend to prevent money from leaving the system. She also highlights the economic impact of the real estate market's current difficulties, not just in residential properties, but commercial as well, noting the potential consequences on GDP. Let's get right into the latest interview with Cathie Wood as she discusses her outlook for the market during this time of economic uncertainty and what we can expect in the coming weeks. Before we dive in, don't forget to hit the like button and subscribe. It's a tremendous help for the growth of the channel and helps us bring you more content just like this.
But what people have talked about, available for sale, you mark to the market right away for that, quarterly. So that hits earnings. Held to maturity, if you sell those, it hits equity. But what they're not talking about is the rest of the asset side of the balance sheet of these regional banks. And it's real estate.
Yes, exactly. They're getting crushed on everything. Yes. Yep.
Commercial real estate, 75% of real estate loans out there, if they're from a bank, are done in the regional banking system. And I would submit that that residential will be hit in another way because there has been so much overbuilding with the capital markets now facilitating this of multifamily homes that we have now coming online, the largest number of apartments in 40 years. In 40 years. So when I look at that, I said, okay, that was real estate speculation. That was inflationary. But I do think that rents will now come down dramatically. Velocity's coming down. And I, again, worry about GDP and economic activity.
Most banks have some amount of unrealized loss in security. How big a deal is that? Who the heck knows? The point is, though, that all like a flock of pigeons, the entire market has been spooked, right? Cash is now a risk asset. People are, moving to money market funds. People are, moving into big banks. All this money is now liquid. It's digital and it's moving around like a cloud and it's looking for the safest thing. And if some of that starts getting out of the system into Bitcoin, that is hyper-Bitcoinization. Or it is Bitcoinization and then eventually hyper-Bitcoinization because it's looking for safety. And once it realizes, if it realizes that actually within the system there isn't safety and it starts seeking an exit, that's basically the thesis. All this money is being rendered super liquid and digital. And then what's going to happen is with something like Fed now, they're going to try to impose capital controls or blocks on it getting out of the system. So that's kind of my thesis, as opposed to micro things about what's going to happen over here. People don't think their money is safe in the bank. The assurances that people are getting are conflicting. They're like, oh, on the one hand, you're responsible for going through all of your bank's 10Qs. And on the other hand, Yellen is saying sometimes that they're going to back all deposits. You have basically not FDIC, but you have FedDIC, right, where all 18 trillion gets backed. The net effect of that is maximum uncertainty plus maximum liquidity.
And so here we're back to the velocity question. Everything you have just said tells me velocity will go down and that the risks to the economy are to the downside here, including inflation. So here we're coming to the same as we started at the beginning. I understand why Bitcoin went from 19,000 on March 13th after the weekend of Signature and Silicon Valley Bank basically going into receivership. It was a flight to safety, 19,000 to nearly 28,000. That proof of concept right there, decentralized, transparent, auditable, and so forth. So we are on the same page here. I worry that this economic downturn, this deflation, is a much bigger problem right now. If you're going to say, well, they're just going to throw money at it. We just saw that the Fed raised interest rates for the first time ever in the middle of a crisis. And today, this week, they've been talking once again about the need to increase interest rates at the next meeting. So I don't think they respect market signals. And this is a big problem. They are not looking at market signals. They're looking at massively lagging and unreliable indicators that are based in a world, the statistics came from the industrial age. So they're not even looking at the right numbers. Pricing signals are the most important signals right now. Credit default swaps, interest rates, yield curves, right? Bitcoin, yes, I agree with that. You might have your hyperinflation of Bitcoin. And I think what we're coming to, you seem to be nodding when I say what I'm saying about the banking system and the risks to the economy, it is not going to be inflation that we're worrying about this year. It will be something else. It may be counterparty risk, but I don't think it's going to be inflation in the prices of goods and services. And many people will say, oh, the dollar is going to collapse. Well, the dollar is measured. If you're measuring it in terms of prices and goods and services, right now it's going up if you're looking at commodities, right? The dollar is appreciating. If you're looking at it in terms of other currencies, after a 25% run in a very short period of time, it's come down. But at the same time it's come down in the last few months, commodity prices have come down. So what does that tell you?
Wood believes that maximum certainty and liquidity can only be achieved by backing all deposits through the Fed, which would provide maximum safety for consumers. She emphasizes the need to add Bitcoin to the monetary base to get a better understanding of the money multiplier. She also discusses the role of Bitcoin in understanding the current state of the banking system. Wood sees the current banking crisis as an opportunity for change. She believes that the stock market is levitating due to the end of rising rates and lower interest rates. She's hopeful that the positive form of deflation will cause enormous growth in blockchain-related innovations like Bitcoin and other cryptocurrencies, as well as robotics, energy storage, and artificial intelligence. Wood does criticize the Federal Reserve for not respecting market signals. She argues that the Fed is not looking at the right pricing signals, such as credit default swaps, interest rates, and yield curves. She emphasizes the importance of Bitcoin as a pricing signal and believes that more people will seek insurance policies or alternative options like cryptocurrencies due to the recognition of what can go wrong with the volatile banking system. What do you think of Cathie Wood's latest interview and the risks associated with the current economic crisis and the role Bitcoin will play? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.